Hello, hello. Oh, hey, Sultan. Nice background.
Oh, I
Oh,
recognize. Thank you. Hi.
I
Good,
rec-
good to meet you over Zoom. All right.
hey, Chris. Good to see you. Maybe you're using your sister's computer, as always says Eunice.
No, Eunice forwarded me the link,
Oh,
and then
oh,
great seeing you as well. Thanks for doing this.
yeah. Are you in New York?
Yeah, I'm still in New York. I should be back in a few weeks.
Okay.
I'll,
Okay.
I'll I'll hit you up. I would love to grab coffee and see you and meet you in person.
Yeah. Oh, yeah, yeah. That'd be great, man. Yeah.
Sure.
I got excited when I saw Eunice's name. I remember her from Cal, but I don't think I've seen her in 15 years.
Yeah. This
I'll
is
let her know. I'll let her know that you said hello.
All
Chris.
right.
You're Eunice's younger brother.
Yeah, I'm her younger brother.
Okay. Yeah, for folks that were in at Cal around me and Tushar's time, Eunice was I mean, she was really well known on campus. Yeah, because she did like student government,
Yeah, ASUC, like student
ASUC.
action and all that. Yeah.
Yeah,
Good
yeah.
time.
Cool. And for the other folks, if you're brave enough to turn on your video, that's always much appreciated. But if you're driving, please do not. Um, but good to see some other familiar faces. Yuchi, good to see you on. You gonna be at basketball in a couple hours?
If you pass me the ball, I consider it.
Deal.
All right.
Where do you guys play, Cliff?
We play at in Oakland. It's a place called Golden Gate Rec Center.
Okay, nice.
Yeah, it's cool. It's like kind of like we've reserved the court. We got about 20 guys, and then it's a solid run just because everyone's about the same level.
Okay, cool, nice.
Hot Tim.
Hey man, how's it going?
Hey, good man. Have you met Tushar before?
It's been a long time, but
I think we
good to
did meet once through.
I think we met either at Cal or shortly after.
Yeah, were you? I think I met you through Terrence.
That's probably right. That's probably right.
I
Yeah.
think
Good to
Terrence
see you
was-
again.
You were in like at Golden Gate or something before, right?
Exactly. Exactly.
Yeah, that's when I had met you.
That's
Yeah,
right. Man, it's been almost a decade, maybe more. But
yeah, probably that's when I was still at Northwestern. So it's been yeah, almost 10 years. Wow, crazy. Good to see you again.
yeah, likewise. Good to reconnect.
Are you in the Bay?
I am. I'm in the Peninsula, down in Burlingame.
Oh, I'm in Burlingame. I live like on El Camino and Mills.
Okay. I
Yeah.
live right by closer to Millbrae, but do you know where the Sutter Health is?
Yeah, my wife and I just had a baby there like 3 weeks ago.
Nice. Congrats. That's awesome.
We're walking distance from there. We're like just a couple blocks south, but it's just still on the Millbrae, closer to Millbrae.
Must be really close. I'm on Truesdale, right across the street from them. So
Oh, okay, nice, cool. Yeah, just walked to that Blue Nardi's yesterday.
that's so funny. Yeah, yeah.
Cool.
All right, we'll give it maybe another minute for folks to join.
The Mills is a great school. I went to Mills.
Oh, you did, nice.
It's a great school.
Is that up? Like if you go up the hill on Truesdale, is that basically what the school is?
I think it's Murchison, but yeah, around there. It's all within the vicinity.
Got it, got
Yeah,
it.
it's all the
I
same.
don't have kids yet, so I haven't figured out the school district situation in Burlingame. But
Oh, it's very nice. It's pretty good, I think.
so I've heard. I have friends trying to buy homes here just for the school district. Tushar, was that your first?
Second, yeah, we have two now.
Awesome. Hopefully mom and baby are doing well.
Yeah, everyone's great. Mom and baby are doing just fine. She was born on the 4th of July, which is kind of cool.
Nice.
Every year I'll be able to tell her that the fireworks are for her.
That's amazing.
Yeah, yeah.
Cool. All right, well, let's get started. Maybe folks will start to trickle in a little bit. But yeah, let's kick things off. And Tushar, feel free to start sharing your screen as well.
Sure.
Just wanted to give a quick intro. So I think most of these folks who are on this call took partake in my real estate class over the last year, and that's how a lot of these folks kind of got plugged into this community. And I'm really excited to have Tushar join us today. I was running the numbers, and actually Tushar and I know each other for almost 20 years. It's crazy to think about how quickly time has flown by. But he has worked in wealth management and financial planning since after college. So pretty incredible. It's been, nearly 15 years of experience at this point. He's an industry veteran. No joke, I have not asked him a question that he has not been able to, have not been able to stump him in the last few years and all the, consultations that we've done together. And today, I'm excited for him to share kind of his knowledge. He's also going to talk about his firm, Twin Peaks Wealth Advisory, and kind of walk through some of their services that they offer, and also talk about financial planning and how it might fit into someone's real estate plan overall as well. So pass it off to you, Tushar, and thanks again for making the time.
Thanks so much, Cliff. I actually remember when you first left tech to come work in real estate, and I was excited. I think I saw your Facebook update that you now have this new real estate business, and it's just cool to see how much your firm has grown from what it was when you just started. And it was just you, and now you've got this really powerful team. So, congrats to you and all of your success, and thank you so much for helping all of our clients that you've helped with their real estate transactions. So, really, really grateful for you and Mee-Sun.
And same to you too, really, to you and your brother too, for all that you guys have built too with your company. It's been great to see.
Thank you. And by the way, I've got one of my colleagues on this Zoom as well. His name is Sultan Beardsley. He's here in case you guys have some questions as I'm going through this. Feel free to just unmute yourself and ask away, or if you'd rather just put a question in the chat, go ahead and post it in the chat, and Sultan will try to answer it while I speak. And if anyone needs any follow-up information after today's session, we can get in touch over email. But there's 3 main topics that we're going to cover today. The first is how you can use your retirement account to invest in real estate. The second topic is the role that real estate can play in your financial plan from both the planning perspective, but also from my kind of nerdy investment world. I'll talk a little bit about how it can play a role from a portfolio construction perspective. So if you think about real estate in your overall net worth, what is the role that it can play? I'll then shift gears and talk a little bit about estate planning 101, but specifically around the benefits of having a trust when you buy real estate. If you haven't already set up a trust and especially if you live in California, I highly recommend exploring that because there's some benefits to doing that, which I'll touch on. And then lastly, I'll share a little bit about our firm and how we work and who we can help. And I'm happy to be a resource to anyone here. So I probably should have gone to the slide before, but these are the topics that we'll take you through here. But let's start with investing in real estate using your retirement accounts. So there's really 2 ways that you can invest in real estate through your retirement accounts. The first is by investing in what are called REITs, which are also known as real estate investment trusts. Think about these as just a fund or a portfolio of different properties. And then the second way that you can invest in real estate is actually by using your retirement account to purchase a property. So those are the 2 things that I'll talk about today. But let's go ahead and start with REITs. Now with REITs, there are both publicly traded REITs, like companies like Vanguard or First Trust, ETF providers out there will create REITs that you can trade every second of every day. Those are called public REITs. There's also private REITs, which is where I'm going to focus our conversation today, since that's predominantly what we invest in here at Twin Peaks Wealth Advisors. But private REITs, really the benefit of investing in REITs is that they can provide consistent income as well as appreciation potential. REITs also tend to have a low correlation to the stock market. So if you've got a bunch of money in your company stock plan or technology stocks, as a lot of my clients have here in the Bay, then having some exposure to an asset that's outside of the stock market can help you with just having an uncorrelated rate of return. Real estate historically has also been an inflation hedge because real estate values tend to go up over time and track with inflation. So we do like real estate for that. Non-traded REITs also offer lower volatility. And I can show an example of that on a future slide, but REITs in general will have kind of less up and down than the stock market would. And if you're investing in REITs in a brokerage account, so kind of outside of your retirement accounts, there's also some tax efficiency that comes with that, which I'll touch on in the second part of this discussion. But moving on, here's how to think about the overall risk to return of investing in private real estate or private REITs. So this chart that I'm sharing with you here is a risk to return plot. And the x-axis here is a measure of risk, and it's going from lower volatility to higher volatility. So ideally, the most kind of risk efficient investment is going to be something that is in this upper left quadrant, because it means that we are taking less volatility, but getting a higher rate of return. And so private real estate has historically been in that quadrant. So we do think it's fairly efficient from a risk to return perspective. That said, if you look at equities or just the stock market, that has done even better than real estate. But of course, you're going out a little bit further on the risk spectrum. At our firm, we invest in just about everything, but I do want to highlight kind of the overall risk return of private real estate. Now,
Hey,
I'll go into
a question related to that. Oh, and sorry, I forgot to mention when I started, if you have questions, feel free to either chat them in or feel free to just unmute and chime in. Curious for the clients that you work with, kind of what percent of their portfolio do you think about allocating to real estate, whether it's in a REIT or private real estate, more on the investing side, not their single family home?
Yeah, so it's anywhere from 5% to 15% of their portfolio that will typically allocate to private real estate. As someone's net worth grows higher and higher, we're okay with having a little bit more in private real estate because the illiquidity matters less when someone is just worth a lot of money and has a lot of liquidity. So yeah, 5 to 15%. I'll go into an example so you guys can see what I'm talking about. This is an example of this is a non-traded REIT that's managed by Blackstone. This is probably one of 7 different private REITs that we're invested in right now. And the way this works is Blackstone's responsibility is to manage this portfolio for the investors. Now, this specific one that I'm sharing with you was designed for income-focused investors. So it's for people who want to generate passive income from their investments, but perhaps they don't have the desire to actually be a landlord or the know-how. And specifically, what's happening in this fund is that Blackstone's going out there and they're investing in a combination of residential buildings like apartment complexes. They also have some exposure to industrial buildings, so things like shipping facilities, warehouse space. And what I like about this is that it gives me exposure to a bunch of investments that I probably couldn't buy on my own anyway, because the properties are just too big, too expensive. And I get the operational expertise of someone who does this all day, every day. But here's kind of a breakdown of how it works. So this specific fund right now, it pays out a 4.6% distribution rate to the investors. They're able to pay that income out every month because they're collecting rent from their tenants and they're passing those rents on to the investors. So let's say you had $1 million invested in this fund. It's going to generate roughly $46,000 a year of income over the course of the year. So just under $4,000 a month. But in addition to that income that gets paid out, there's also property price appreciation potential or depreciation potential, depending on how the market does. But you can see over the last 3 years, it's generated almost a 12% annualized rate of return, which also does include that 4.6. So you can see the appreciation has been about another 7% on top of the yield. Now, I want to highlight some things here that kind of speak to the consistency and the lower volatility. So the first circle here is March of 2020. And that's when we had the big COVID shutdown. I think the stock market fell 34% in just 2 weeks. Private real estate held up quite a bit better during that time period. And it was only down 8%. So that's a lot easier of a pill to swallow for a lot of people. And the reason that it doesn't fluctuate quite as much is because it's not traded every second of every day. So you're not going to be susceptible to the swings of kind of erratic investors who are pushing the sell button when times get tough. On the right-hand side, you can see the returns year over year. This fund was launched back in 2017. It's done fairly well. Hasn't lost money yet. I imagine that one day they will, but I think it just speaks to the consistency. Now, when I evaluate an investment like this, what I think about is, okay, well, if I'm going to take on some illiquidity through a non-traded REIT, what is my alternative, right? My alternative would be to buy, say, like an ETF that invests in REITs, which I can buy and sell every day. And I kind of compare the overall risk to return. Private REITs have done quite a bit better. I think this fund has done almost double what like the Vanguard REIT has done. So I tend to try to stick to private REITs when I can. I'll pause there for a second, but any questions so far on REITs?
Hey, Tushar, beyond.
Okay, go ahead.
Sorry, go ahead. I just had a quick one, which is beyond the 4.6% or just the monthly distributions in general, what would be your mechanism for getting liquidity out of a private REIT?
So then you can also just redeem your shares in the fund. So every month, in this this REIT has monthly liquidity. So if you want to get your money out, we put in a redemption request, and your money should be out within 30 days. There are one of the stipulations with investing in private REITs is that the fund does have the ability to gate the fund if there are excess withdrawals. So if everyone is trying to take their money out at the same time, they'll typically cap their redemptions at 5% of the fund value every quarter. So
And then you're just subject to whatever their mark to market is,
that's correct.
the redemption. Okay.
Yeah. They price this specific fund is priced every single month, so it's fairly consistent.
Got it.
Yeah. There are periods of times where a number of investors are trying to get out at the same time, so it can take several quarters to get your money out if that happens. So just something to keep in mind.
Tushar, what do you mean by a private REIT?
Where do you buy one?
Or yeah, what do you mean by it being a private REIT?
Yeah, private REIT means it's not like securitized and traded on an exchange every day. So if we're buying a public REIT like a Prologis or a Simon Property Group, you may have heard of those companies. Those trade like stocks on an exchange. You can just buy them and sell them every single day if you want to. But the private REIT, it's less liquid. They're typically only taking money in once per month or once per quarter, and they're also only letting money out once per month or once per quarter.
Gotcha.
Most of the private REITs will typically have a 1-year lock on the investment with anywhere from a 2% to a 5% early withdrawal fee, because they really only want serious investors. They don't want finicky investors.
And just to build on Cliff's earlier question, so 5 to 15% of a portfolio typically in just private REITs, and then something on top of that in terms of what you'll typically do with public REITs?
I will rarely buy public REITs in a client's portfolio, if it's unless they really need the liquidity. Otherwise, I will generally invest in private REITs.
So 5 to 15 is basically the full kind of real estate allocation. Okay.
Correct. Yeah, that's right. And by the way, if anyone wants more information on this specific fund, just type REIT in the chat and Sultan can send you an email we have like an informational email we put together on the specific product. All right, I will keep going. So let's talk a little bit about using your retirement account to buy physical real estate. So I get this question all the time from clients is, like, how can I leverage all this money that I have in my old 401ks and IRAs to buy property? So the first step that you would need to do in order to actually do that is to open what's called a self-directed IRA. There are a number of providers online that can help you set up a self-directed IRA, but the Entrust Group is a very popular one. I've had a couple of clients use them and they've had a good experience, but that's really the first step. Once you have that account opened, you do need to fund the account. So the most common ways I see my clients funding these accounts are you either just doing an IRA to IRA transfer or moving money from like a employer's 401k plan into their IRA account. There are some administrative fees to managing and maintaining a self-directed IRA. The provider can talk to you about what that is. I think it's around a few $100 a year. It's not something crazy, but there is some administrative cost that comes with using one of these providers. Once you have the money in the account, you do want to learn all the rules and regulations around what you can and can't do in terms of the property that you acquire within that IRA. And I'm going to get to some of those rules and regulations on the next slide. And then finally, you can purchase the property. So let's get into like what you can't do, just so you know what to avoid if you're going to go down this path. So, okay, these are the 4 main categories of prohibited transactions. If you use your IRA to buy a property, you can't rent it out to your child. So typically, family members is going to raise a red flag. It's not going to qualify for this type of transaction. You also cannot use your self-directed IRA funds to invest in the real estate of a spouse's business. So that would be something that would be disqualified and not allowed. You also cannot use it to purchase goods or services or facilities between your IRA and a disqualified person. So as an example, you couldn't use it to paint the walls of the condo that you bought or hire someone to do work for that. It has to just be the asset. And lastly, If you are renting out the property that you buy inside of your self-directed IRA, that income needs to be paid back to the IRA. Now that's an advantage because you're not going to pay any tax on that monthly income that you're getting. You will ultimately pay tax on that once you cash out that IRA, but you can't take the income that you're paid every month and put it in your bank account. So those are things to avoid. To be honest, I've only seen maybe 1 or 2 clients in my 15 years of doing this actually execute on this in the Bay Area, because properties here are so expensive that most people just don't have $1 million or $2 million bucks in their IRA sitting around. Where I see people doing this more often is like in the South and the Midwest, where you might be able to use a couple $100,000 IRA and go and buy a single family home in North Carolina, for example. And then you can make that offer all cash.
Yeah, just to add to that, I've seen that be really is exactly as Tushar mentioned, kind of in non-California, non-coastal states, a really popular investing strategy. And if there are follow-ups, you can reach out to Tushar for questions, but also Bigger Pockets has a lot of good threads. Bigger Pockets, the real estate community, has a lot of threads on how to invest through your IRA to buy investment properties too.
Yeah. Any other questions on buying physical real estate? Cool. So let's move on to the next piece, which is kind of the role that real estate plays in your financial plan and how it can be a proponent to building wealth. So I'm going to touch a little bit about kind of portfolio construction and how to think about investing in private real estate. And then secondly, I'll talk a little bit about the tax efficiency that comes with it as well. So let's keep going here. By the way, I'm going to put my email address in the chat just in case anyone has a question that they want to personally ask me. You're welcome to email me as well. But yeah, so really the 4 benefits of investing in private real estate are portfolio diversification, lower volatility, income consistency, as well as tax efficiency. Those are the key things that I'm going to touch on as I go through this. All right. So as you think about building a investment portfolio for yourself, the kind of the 3 main buckets to consider are fixed income or bonds most commonly, real estate, and then equities or stocks. Equities tend to be very appreciation oriented, so you're typically not going to generate a ton of income from your stock market investments. I know there are some exceptions to that, but broadly speaking, equities are more growth oriented. And then bonds, on the other hand, are very income oriented, right? You're not going to see a ton of appreciation or depreciation in bonds typically. Real estate is kind of a good middle ground because they offer some income as well as some appreciation. So as I'm looking to build out portfolios for my clients, I was using real estate fairly heavily over the last several years because interest rates were so low. So real estate and other types of high yield fixed income is where we had to go in order to generate current income for investors. A lot has changed now in the last year with interest rates being much higher. We can actually get a lot of income from traditional fixed income investments. But that's sort of the role that it plays. You get a little bit of both. Let's talk. This is kind of the nerdiest slide on here, but this slide really just speaks to the correlation that private real estate has to other asset classes. And why I like it is because there's just generally very low correlation. So if we look at private real estate, it only has a 0.2 correlation to publicly traded REITs. So even though they both are invested in real estate, it has a very, very low correlation. By the way, correlation runs -1 to 1. So a 1 means it's perfectly correlated. To stocks, 0.1, so barely correlated at all. To bonds, it's actually inversely correlated. And to municipal bonds, inversely correlated as well. So I think it really does a good job of diversifying the portfolio. I'll draw your attention to something too. Let me go back a couple slides. I think will illustrate this. So if we look at this Blackstone performance chart, look at the rightmost column on the year-to-date performance. 2022, right? Not a good year for the stock market. The market was down 19%. This fund was up 8%. So that kind of speaks to the value of being uncorrelated. 2020 March, right? We saw that this held up quite a bit better. I think 2018 was a down or a flat year in the stock market as well, and this was positive. So, yeah. Any questions so far on correlation or portfolio construction? Yeah. And then I think Cliff, you had asked about publicly traded REITs. So one of the main reasons that we consider private versus public REITs is because of the lack of volatility here. So you can see the green line is private real estate since 1997 and the volatility associated with it as compared to publicly traded REITs, which have gone up and down quite a bit more. So I really like the idea of investing in REITs privately for this reason, because if you think about your house, right? If you own a house, right, does the value of your house really change that much from second to second or from week to week? Not really, right? But in the public markets, crazy things happen where the value of a real estate fund could drop 30% in 2 weeks. And so we've seen that happen time and time again. And I think that is just managed a lot better in the private space. All right. I do also want to speak a little bit about the income consistency. This is one of the primary drivers that really brings people to real estate in the first place, is because they're looking for ways to generate passive income. So over the last 20 years, private real estate income has been extremely consistent. I think over the last 17 years out of 20, the private REIT index has had a distribution of over 4% per year. There are some REITs that are now north of 5%, which is pretty good. But 0 years of under a 3% yield, even in that low interest rate environment that we were in for about a decade. No private REITs were under a 3% yield. So really consistent on the income. Most REITs will pay out income either every month or every quarter to investors. All right, and the last thing I'll touch on kind of real estate as a wealth building tool is the tax efficiency. So earlier when I spoke a little bit about that 4.5 or 4.6% distribution rate, keep in mind that with real estate, they're able to pay that income out to you as either like a return of capital as opposed to profits or income. So it's a very tax efficient yield. So even though you're getting 4.5%, typically 90% of that is going to come back to you as return of capital. So maybe 10% of that will be subject to income tax. The reason I say maybe 10% is because it really depends year to year on what transactions are happening inside of that REIT that you're invested in. So if they sell a property that has a high capital gain, then maybe there'll be more income tax 1 year. But for the most part, the REITs that we're invested in have an 80+% tax-free income. So even though you're getting 4.5, 4.6 a year, the tax equivalent yield is closer to 7%. So and that's really powerful. Like imagine if you had $1 million in a brokerage account invested in one of these REITs, and you're getting $45,000, $46,000 a year, and you're only paying tax on $4,000 of that. Right? It's like $1,500 in taxes. It's nothing. It's pretty meaningful. Any questions on the tax treatment here? Okay.
You talk about tax treatment upon kind of full liquidation.
Yeah, upon full liquidation, you're going to pay a capital gain. So each year that you're getting the distributions, your cost basis in that investment will go down slightly because you're getting some money as return of capital. Ultimately, when you sell the investment, you'll get a capital gain. So you guys may have heard
the lower cost basis.
On the lower cost basis. Correct.
Okay.
So you guys have probably heard this before, but there's a tax strategy that the wealthy use, which is defer, die. Right, so you want to defer your taxes as long as you possibly can, and then ultimately when you pass away and your heirs inherit the money, they will get a step up in that basis. So I've seen a scenario where someone invested $1 million into a REIT and they just held it for 40 years, and that their cost basis basically came down to zero. And I think the property was worth the investment was worth 3 or 4 million. They sold that, they would have a massive capital gain, but if they just hold that till when they pass away, their heirs get the full step up in basis and there's no $1 million in taxes. So you want to be strategic about where you own these assets. So I think there's a case to be made to invest in private REITs, both in your retirement accounts as well as in your non-retirement accounts. I think the huge plus for investing in your non-retirement accounts is that it's a very tax efficient yield as compared to other types of fixed income you might invest in. In your retirement account, I think it could also make a lot of sense because the illiquidity matters less to people in their IRA accounts because they're not going to touch it anyway until they're 60. So having a 1 year lockup and monthly or quarterly redemptions is not a huge deal in a retirement account. So there's benefits to both. All right. let's move on to estate planning 101. So I'll talk a little bit about the benefits of setting up a trust, specifically as it relates to real estate. And
Hey, Tushar, sorry to interrupt you. Just
Yeah.
one last quick question. Do you get the same tax treatment with public REITs in terms of your distributions being treated as a return of capital?
I'll have to get back to you. Actually, I don't know the answer off the top of my head. I would imagine they'd have some type of classification like that, but I don't know. Sultan, if you can take that down, I can look it up and get back to them.
Cool. Thank you. Appreciate it.
All right, so let's talk a little bit about estate planning 101. So really the main reason to set up a trust is to keep your assets out of the probate process. And if you're not familiar with probate, it is the process that all of our assets go through after we pass away. It's basically the court process that our assets go through to make sure that they go to the right person. But if you don't want your family to have to deal with the court system, and if you want to avoid kind of the lengthy and costly process of probate, you can simply set up a trust and put all of your assets into that trust. And trust held assets are kept away from probate. So to provide some like color on probate, so the average cost of probate on $1 million net worth in California is about $40,000. That's how much your estate would pay in court fees to the probate officer and the attorney, just to give your money to your family members or whoever you're leaving your money to. You can get away from that cost completely by simply putting all of your assets into a trust. So I would recommend setting up a trust, putting like your brokerage accounts, your bank accounts, your real estate especially into the trust. It's particularly important for real estate because your property doesn't come with a beneficiary form, right? With your IRA accounts and brokerage accounts and bank accounts, you can fill out beneficiary forms to keep those accounts and stuff out of probate, but you really can't do that with your real estate. So you do need to have that in a trust or like an LLC or something if that's the route that you're going to go. If you already have property that you've purchased, that's okay. You can still set up a trust and then do a deed transfer. There's a little bit of admin cost associated with that. It's not much. It's like $400, but you can transfer your deed from your name into the trust. So and there's no like change in taxes when you do that. So it's not too late if you've already bought a house in your own name.
Just to add to that, yeah. So yeah, just to put a plug, Tushar and Vishal, they helped us with our real estate too, to transfer it into a trust. And this was after we had owned it for a little while. So exactly kind of what he talked about there. And it was a really just smooth process. It was the first time that I had gone through it. But I think anyone on this call, if you own real estate, highly consider a trust. But more also, if you have kids, that's also, I think, where it's almost like a must to really have that. The real estate would go to your kids and avoid the probate process. Tushar mentioned the $40,000 like money cost, but there's also the time cost as well. I've heard of probate proceedings taking months as well. And so just to make your kids or family members go through that after you've passed is just an additional headache that can be easily avoidable.
Totally. I just had a client, unfortunately, her father passed away in Palo Alto and left her and her brother like this $3.5 million house. He didn't have a trust set up, and it took them 9 months of going back and forth with the court just to prove to them that they are the kids and everything goes to them. And they spent $60,000 in total fees just to get a house that should have been theirs to get, without any cost. So
yeah,
I would recommend that. If you have kids, the other things you can do is you can specify things like who their guardians would be, when they can use your money, and things like that. So typically the most common reasons to set up a trust are you own property or you're going to own property in the future, you have children, you have illiquid investments like angel investments or private equity or venture investments, or if you want to just specify who gets your money. I did want to specify one thing on the LLC stuff. So if you own real estate in an LLC, I still recommend having a trust because you can assign your interest in that LLC to your trust. And that's just a document that would say, hey, look, I'm Cliff and I have all of these LLCs with a big net worth. I want to make sure that goes into my trust and then to my beneficiaries. It's called a business assignment. We can also help you with that process. Or if you have a bunch of illiquid investments like private equity funds, venture funds, you can also draft a form, or a one pager that would say, hey, look, I'm Cliff and I'm invested in Vista's private equity fund. Let's, I just want to make sure that this is also going to my trust. So.
Star, it looks like we have
Alice. Oh yeah, go ahead, Sultan. Yeah.
oh yeah, I just want to say, it looks like we have a question in the chat from Alice.
Oh, sorry, it's necessary to put the bank accounts into a trust in addition to the house. So the short answer is yes, and generally speaking, it's best to have everything titled in the trust, assuming that you would want it to go to the trust's beneficiaries. Bank accounts, however, they also have what's called a payable on death form that you can fill out. And if you don't want to retitle that account to your trust, you could simply name your trust as a beneficiary to that bank account. And because there's a beneficiary assigned, that also would not go through probate. So. I think that's a high level gist of estate planning. There's 4 main documents that a typical estate plan would contain. There's the power of attorney, which is where you specify who would make financial decisions for you if you're unable to make them for yourself. There's the actual trust, which is the entity that can own your assets. By the way, the question I often get is, are there tax benefits with setting up a trust? There can be, depending on the type of trust that you set up. The type of trust that I've been talking about right now is just called a revocable living trust, which is just really a pass-through entity to you. So there's no special tax benefits of this type of a trust. There are other types of trusts called like irrevocable trusts or charitable trusts, which do have some tax benefits. That's kind of beyond the scope of today's talk, but if you're interested in learning about those, just drop me a note in the chat or send me an email and I can get you some more information. There's also a will, which is where you can specify, who would get what, so does Uncle Joe get your car or whatever, you can specify that in your will. And then there's a healthcare directive, which is where you'd specify who would make healthcare decisions for you in the event that you can't make them for yourself. So it's really important to have. It's a little bit kind of morbid end of life planning, but I think it's important to have your ducks in a row. If there's no more questions on estate planning, I'll spend a few minutes just educating you about our firm and how we can help. Cliff, do you have anything else you wanted to ask?
No, I just wanted, it's funny, the healthcare directive, that is a nice way to put it, because when Mee-Sun and I filled out that form, it really makes you think through a lot of like tough, morbid kind of questions, like, like if you're in a vegetative state and you can't make your own decisions, at what point do you kind of pull the plug, or like how long do you stay in that state? It's tough stuff to talk about, but important, right? Because it's at some point those decisions will need to be made for each person. So it's just kind of, I think, it's better to plan for those than for your family members to have to make those decisions in the moment. So I thought that was a nice way to put it, healthcare directive. But yeah, those were some tough questions.
Yeah. Cool. All right, so a little bit about Twin Peaks of Wealth Advisor. So my twin brother Vishal and I, we started the firm, and we've been in this business since 2009. Our firm now serves 500 clients across the country, and really our mission is to help people achieve and maintain financial security for their lifetime. Our clients are typically people who are, highly successful professionals across the country. I think like 70 or 80% of our clients are located here in the Bay as a result of us being here. My twin brother splits his time between New York and the Bay Area. So if you're out in New York and want some guidance, he's there 3 weeks out of every month, and happy to meet with you. But typically people are coming to us when they're either too busy to manage this stuff all on their own, or perhaps they're just looking for an accountability partner to make sure that they get some of this stuff done and have some perspective along the way. There's really 2 models in which we work. We have a flat fee financial planning model, and then we also have a kind of a traditional assets under management, kind of like managed account model. So I'll speak to both of those. On the flat fee side of things, these 2 packages that I'm sharing on my screen, these are really appropriate for people who are really looking for more of like a one-time assessment on their situation, or they're perhaps at a point where they're not yet ready to turn over the account management to a professional. So we call them our essentials and complete plans, but as an example of what we would cover with you guys in that scenario, we'll help you think through managing your cash flow and help you determine how much you're saving. If you're interested in buying a house, we can help you model out how much house you can really afford. And I think Cliff has a model for that as well, but We do that all the time. So if you think about either your primary residence or investment real estate, we can help you guys really put together some pen and paper and determine what is appropriate for you to purchase. If you work at a company where you have publicly traded stock, we can help you think through your diversification plan and kind of put that on autopilot. We'll also help with modeling out things like education and college funding if you have children, as well as insurance planning. So things like life insurance, disability insurance, long-term care insurance. If you're working at a company, you probably have some of that stuff already, but we can help you determine if you need more and what that might cost you.
Tushar, can you share a few quick words on just general guidance for college planning, or tuition planning for parents that you usually share?
Yeah, there's two main things that I see people doing. So the first is what's called a 529 plan, which is a college fund, and that's a tax sheltered account for you to invest money for your kids' education. If you're married, then you and a spouse can contribute $34,000 per year to that account, and the tax treatment on that is just like a Roth IRA. So it's initially funded with post-tax money, and then it grows tax-free thereafter. And what's cool about 529s is that since I think 2016 or 2017, you can actually now use those for private K through 12 tuition as well. I think there's a limit of like 10 grand a year that you can take out, but you don't actually have to wait until age 18 to use those anymore. And then there's also a new law that just passed that will allow you to convert 529 excess contributions to Roth IRAs. So in the future, if your kids don't use all of the money, you can convert some of that over to a Roth IRA tax-free periodically. So that's the first thing I see people doing. The second thing is just setting up what's called a custodial account, which is really just a brokerage account for your child. And the nice thing about a custodial account is that you can use it for anything. So if you want to buy him or her a car when they're 16, great, you can do that. There's no stipulation around education. The trade-off is that there's no tax benefit on that account. It's just going to be subject to normal, dividend taxes and capital gains taxes year to year. Our complete plan here, by the way, on the right side, this is more appropriate for people who have more typically more complex tax planning related things. So if you have a highly appreciated stock or a massive capital gain you're getting from an investment that you have, if there's some creative ways to shelter that from taxes, we do charge a little bit more for that. But that's our flat fee model. And then our second model is what we call our just complete wealth management. And that's where we pair all of the flat fee financial planning stuff, which is the left side of this concentric circle. And we pair that with the actual investment execution. So our team conducts the risk analysis for you. We help you build out your portfolio. We also provide access to alternative investments like the private REITs that we discussed earlier. We also invest in like private equity as well as private credit. So there's some exposure to stuff that isn't publicly available. But this is really appropriate for people who are looking to delegate their kind of entire financial situation to a professional team, and then basically just have to show up to quarterly meetings and then we execute the rest. So, and we just charge a percentage of the assets under management each year. Any questions there?
Sure. Could you share maybe a little bit under this model, like how much you're typically able to save your clients in taxes? I realize this might be like a loaded question, but even just anecdotally, like how much juice is there to squeeze when someone typically comes to start working with you?
So it really varies on the situation. Like I can see from your picture that you work as an investment firm, Goodwater. Is that a venture firm or something?
Exactly, VC firm. Yep.
Right. So if it's in your world, you're probably going to have some investments that end up having massive capital gains. So in that scenario, what we would do is we'd help you mitigate those capital gains taxes through things like qualified opportunity zone investments, or we can even invest in like solar projects, which are getting special tax treatment. I wish I could give you like a percentage or a dollar amount, but it's completely case by case because each of those scenarios require some kind of a trade-off to the investor. I'll give you an example of someone that I helped last year. So this guy had a $2 million capital gain. It was a private equity fund, and the tax on that was going to be about $800,000 between federal and state. We had him invest $200,000 into a qualified opportunity zone fund, and that saved him about 80 grand in taxes. But that investment is now illiquid for 10 more years. So we could have offset the entire thing if he was willing to invest all of the proceeds, but it really came down to how much liquidity he was willing to part with.
Yep, got it.
Yeah. But VC and private equity professionals are probably the second biggest area of focus for us behind just kind of traditional tech employees.
Makes sense. And even in terms of things like purchasing real estate in the most tax efficient way, right? Or structuring your overall portfolio in the most tax efficient way. But even things we've talked about on this call, like those are all things you'll just kind of work with somebody on an ordinary course basis. Is that
That's
right?
correct. Yeah,
Okay.
exactly. Think about us as like an add-on to your financial planning situation, or like a thought partner, right? So as you're thinking through things, you can surface these ideas to us. Some of them we'll bring proactively to you just because we know what you'd be going through, but you'll inevitably have certain things that you have questions about, and chances are we've dealt with it before or know someone who has.
Okay. And then, sorry, just one last one for me. Are you guys actively managing these portfolios where you're kind of rebalancing on behalf of your clients and all that stuff?
Correct. Yeah. If it's a managed account, we take care of all of the ongoing management. There's no clients do have the ability to trade their accounts if they want to, but it's designed to be hands off from your perspective.
Got it. Thank you.
Yeah, correct. In terms of what we invest in, it's everything from stocks, ETFs, index funds, mutual funds, private equity funds, structured products. There's a lot of stuff out there. So just about everything.
Actually, related to that, Tushar, yeah, I am sure every client you have a different relationship with and how you work with them. But are there some clients of yours where like all of their bank accounts are essentially like you help manage all of their finances from A to Z? Like, hey, I need to put a down payment on a home, or hey, I'm gonna buy this car all cash. Your team will actually help put that wire transfer into, or is that like there's that's where you guys draw the line of?
No, we can wire to escrow for like actually, yeah, Cliff. So if any of my clients are ever buying a house with you, some of them will just choose to wire the money directly, but we can wire for them as well.
Oh.
Yeah. We use Charles Schwab and Fidelity as our custodian. So there's a lot of capabilities with both of those. You can do just about anything.
Yeah. To give you another example, Hatem, so Mee-Sun and I used Tushar and Vishal around some of the Stripe IPO planning. Or I guess it didn't IPO, but they did a tender offer. And I had I didn't really know what was going on. They had some good insights to share, but just also from their knowledge of what other Stripe employees or what their other clients have done in those scenarios, that was really helpful as well. There's different like elections that you have to make based on what tax percentage you want. And it was just good to have someone that was an advisor there to help with some of those decisions. And then I bounced some of the ideas off of them because I was like thinking, well, can I elect for the lower tax amount? Because then as a real estate professional status, I can probably reinvest that in other stuff and get some tax benefits to offset. And, they were able to help like confirm and be like, hey, that sounds like a good idea. Check with their CPA, but that sounds like a good idea. So that in of itself, was worth, the price of bringing them on to help with that.
Yeah, and that's kind of what I was getting at as well. I feel like there's just so much value and savings for your average person that it more than offsets, well, to your point, whatever the cost is of getting that advice. Where even folks that spend their careers in financial services, myself included, have like zero. Like for me, I do zero tax planning and optimization, so like anything would be incremental to that, right?
Yeah, absolutely. I mean, we've priced our stuff in a way that we want to make sure our clients are getting more value than what they're paying us, and so we've priced it accordingly. But I would say try to think about our relationship as less of like, okay, I paid you X, and did you save me Y, or did you make me X amount? Some of our value is also just accountability, making sure that you're thinking about things when you're supposed to be thinking about them, and just also having a thought partner to make sure and gut check decisions before you go into big transactions. So. You'd have to value kind of that professional guidance to some degree for this to be a fruitful relationship for both parties, but that's how we think about it.
Yeah, I think your point around like all of your clients being really busy professionals makes a ton of sense, because like this, almost is, I mean, clearly it is something that can and should be someone's full-time job for their own financials, but none of us have the additional 40, 50, 60 hours a week for it. So
yeah. Totally. Look, I tell all my clients this is that, financial planning it's not rocket science, right? Everyone on here is a smart person. If you guys did what I did every day, you would do it just as well as I did, if not better, I'm sure. But it's just about having the time. Same goes for Cliff, right? Anyone can become a realtor if they pass their license and take themselves to it through a transaction and save that cost. But right, why do we work with Cliff? Is because he's smart, he's knowledgeable, he's done, knows how to get these transactions done, in a thoughtful way.
Yeah, I forget the name of the Haas professor, but I think we had the class over the summer, and gosh, there's the professor who gave us the Jim Jubak picks. That was his book, like he recommended it. And anyway, his rule of thumb was like every asset in your portfolio, spend 5 hours a week on it. And it's like, great, that sounds awesome in theory. You know, yeah. So
5 hours a week. Yeah. I'm gonna do that for myself, and I do this professionally. It's a lot.
yeah, exactly. Exactly.
Makes sense. Cool. That's about everything that I had for today's session. I have another 9 minutes I can stay on. If you guys want, I can share an interesting investment idea that is not in real estate that I think is pretty cool right now.
Yeah, sounds good. And if anyone has questions, feel free to unmute or type it into. That sounds good.
Okay, cool. I'll share this. This is outside of real estate, but an asset class that we are investing in pretty heavily right now at our firm is something called private credit. This is also a private investment, but private credit investing is where a large private equity fund like a Blackstone or a Carlyle they'll basically lend money to corporations, and they'll charge interest on those loans. So it's a very simple business model, right? Lend money and charge interest. But the reason we like it is because we think that the yields are nice now. So first of all, with interest rates going up, the yield that investors are able to get on private credit investments are now north of 10% per year. But we also think that they are very risk efficient loans. So typically when a private equity firm is giving money to a corporation, they're going to put themselves in as what's called, here we go here. They're going to put themselves in as what's called first lien senior secured debt. It's really just a fancy way of saying we get paid first if you guys go under. And so we like this asset class a lot right now because we think the default risk is still fairly low. As I was evaluating different fund managers, I approached Blackstone. They're one of the biggest in the space. And I asked them, I was like, what is your default rate on these loans? They said, we go into building a portfolio assuming that we'll have about a 4% default rate, but right now we are under 1% per year. And even in the scenarios where a loan does default, they have a 99.89% recapture rate on their principal. So it's been a fairly they've really just done a good job of securing that principal. The yield on it is about 10.1% per year right now, and that income gets paid out on a monthly basis. So let's say you had $100,000 invested in this fund, right? You can expect about 10 grand a year of income that gets paid out for about $830 a month. The illiquidity on it works like this. It has a 1-year minimum hold. If you want to get out of the first year, there's a 2% early withdrawal fee. After the first year, the fund is liquid on a quarterly basis. So you can get your money out, but it can take up to 90 days to get your money out. So yeah, to give you an idea of some of the companies that they're lending money to, you guys will be familiar with some of them because they're here in the Bay, but like Mimecast is a software company. They're borrowing money from Blackstone. Medallia is here in the Bay Area. Zendesk as well, right? San Francisco company. So yeah, it's kind of an interesting place. I'm personally investing here myself now too. Any questions? Thoughts?
I just threw one in the chat, but is the way to think about this that the price of the asset will just come down as interest rates come down as well? Like does it devalue if you bought this now and then wanted to liquidate in a year?
The fund does have a price, but they've designed this because their goal is to basically have the price stay steady and just have this be really an income generating tool. The fund, the value of the loans, I guess, could go up and down a little bit, especially if there's defaults. But for the most part, I would go into it assuming that your principal will likely come back plus the interest. What can change as interest rates change though is the yield. So as an example, right now the distribution rate is 10.1%, but just a year ago that rate was about 8%. But we've seen rates go up, so the yields on these loans have also gone up. I'm okay with yields falling if that happens in 2024, which is what the Fed is sort of hinting at. But even in 2022, before the rate hike started happening, this was paying out 8.1%, which is pretty solid.
So is your suggestion for folks, like if they're holding, well, I think holding cash right now might be a little bit silly. Like I think most people are moving them into like short-term treasuries.
Yeah.
ETF like SGOV. I've had some funds in there, but like moving some of that allocation into something like this, that you don't need liquid I assume.
Yeah, I've been repurposing some of my clients' traditional fixed income assets. So if they own like bond ETFs that they're okay with having locked up for a year, I think this offers more return. You just have to be okay with that illiquidity. But yeah, private credit has been one of the best risk to return asset classes in the last 15 years. I think it's just slightly outperformed equities over the last 15 years, despite being a debt instrument. So, and I think the other thing that's changed with, with Silicon Valley Bank going under and the stuff with First Republic that happened, banks have become much tighter with their lending, and it's actually increased opportunity for other lenders to come in and pick up some of that business, because not all corporations can just go to a bank and get a loan anymore. So these private equity firms have an opportunity to lend. And people often ask me like, okay, well, why would I go, why would a corporation go to Blackstone or Carlyle and take out a loan at 12 or 13 or 14%? In some cases, they can't go somewhere else, but in other cases, what these private equity funds do is they'll kind of sell these companies on their ecosystem. So like when someone comes to Blackstone says, hey, yeah, we'll give you the money, but we'll also help you grow your business. Like look at all of our partner companies and portfolio companies to see if we can help you grow sales, or see if there's customers in our book of business to help your business out, right? Because it also helps them kind of secure their principal on the loans. So that's kind of the selling point. Yeah.
I mean, it's crazy that you can earn 10% yield on like first lien debt of like Medallia and Zendesk and all these, what I assume to be like A-rated credit companies.
Yeah, I mean, the top 5 industries they're lending to are software, professional services, and healthcare providers, and it's because they're highly cyclical and predictable. They have a 43% average loan to value, so they have a lot of collateral. I spoke with their portfolio team last week, and they were saying anytime they give a loan, they assume that they go into it assuming that the company could lose 25% of its revenue in a year, and they want to make sure that the loan would still hold up in that scenario. So they take a pretty conservative approach, but yeah, it's done fairly well. I mean, Blackstone is Blackstone. They know what they're doing. But yeah, if any of you guys are interested in that as well, feel free to reach out. We can talk through kind of the nuances, and so I can send over like a prospectus and documents and things like that on this fund.
Cool. That was a neat idea. That was eye-opening.
Yeah. But yeah, thanks so much for having me, Cliff. I appreciate everything you do, and love your work, and I'm just glad I could be a part of this.
Same. Yeah. Any other questions from folks? Otherwise, we can end a minute or two early.
No, this is awesome. Thanks, Tushar. I really appreciate your time, and Cliff, appreciate you organizing. It was fun.
Yeah, of course. I didn't realize you're in Burlingame, so we'll have to get together for coffee or something.
That's right. I'll probably run into you walking to Lunardi's next time. So.
Yeah. All right. Thanks, everyone. Have a good night.
Okay. Yeah. Thanks for joining, everyone. Take care. See you, Tushar.